You paying attention now? Welcome back to the course. Lesson 7, break-even analysis. This is a super important theme on the exam, so let's get into it. By the end of this lesson, you're going to be able to understand this graph, baby. Oh yeah. First, let's talk about why businesses do break-even analysis. They do it to determine the precise sales volume where total revenue equals total costs, ensuring they do not operate at a loss. Here are the key terms you need for break-even analysis. First, we have the break-even point, and this is the point where total costs equals total revenue. This is a magic point for break-even analysis. We're going to take a look at what that means in a second. Then we have break-even output. This is a level of output or sales at which total revenue equals total costs, so the business makes neither a profit nor a loss. So that's the definition of break-even, is you're not making a profit or a loss. So you're not losing money, but you're not gaining it either. Then we have the margin of safety. This is the difference between the current or expected level of sales/output and the break-even output. It shows how much sales can fall before the business starts making a loss. So if your break-even output is 1,000 units and you're selling, let's say, 1,500 units, then your margin of safety is 500. And don't worry, we're going to take a look at that on the graph and on a table, so don't worry. And then we have contribution, the amount each unit sold contributes towards covering fixed costs and then profit. It's calculated as selling price per unit minus variable cost per unit. So let's take a look at this graph here. Knowing what I just told you about total costs equaling total revenue, where do you think the break-even point on this graph is? Go ahead. It's here. Take a look. This is where total costs, the red line, meets the total revenue, green line. This is where total costs and total revenue meet. So if we take a look at this on the table, you'll even see that. Take a look. 1,250 units, total costs, 25,000, total revenue, 25,000. You see, I put that in bold just to emphasize that this is where the total costs and total revenue are the same, and you can even see that on the table. Now take a look at this infographic. The break-even point is labeled. And by the way, this is the same data as before. I simply plotted it on my own graph in order to make it more clear. So as you can see, at 1,250 units, the total revenue and total cost lines cross. This is how you know this is the break-even point. Now, let's say that we're currently operating at 2,000 units. We're outputting 2,000 units. As you can see labeled on the graph, the area in green on the right, that's your profit area. And the area in red on the left, that's your loss area. Well, here, if we follow the total cost and total revenue lines, we get a pretty clear picture. When total revenue is higher than total costs, you're in profit. When total revenue is lower than total costs, you're in loss. And when they cross, that's the break-even point. Now, if you look at the bottom of the graph here, you're going to see the term margin of safety. Remember, this is the difference between how many units you're selling and how many units you need to sell to break even. So let's say that we're currently outputting 2,000 units. Well, there's 1,250 units we need to output to break even, so that means our margin of safety is 750 units. And we can look at any point on the graph and figure that out. But look here at the additional column on the table here. I added an extra column. You see, we have the margin of safety. When you're outputting 0, your margin of safety is negative 1,250. Why do you think that is? Well, it's because at 1,250 units, you're breaking even. So if you're outputting 0 units, what's the difference? It's negative 1,250. A quick rule of thumb for you here. If the margin of safety is negative, then you're in loss. If the margin of safety is positive, then you're in profit. If the margin of safety is 0, then you're breaking even. Boop, boop. Red alert, red alert. Past paper question incoming. Boop, boop. Here's your past paper question. It says, FBW manufactures watches using job production. It employs 5 full-time production employees. Each worker is offered regular training. Last year, FBW sold 600 watches. The managing director plans to use break-even analysis to help decide whether to increase the price of its products. FBW's current break-even chart is shown in Figure 1.1. Let's take a look at Figure 1.1. Here it is. Take a look. Immediately, you should be able to point to the break-even point. Immediately. Where do you think it is? That's right. It's at 500 units produced. 500 watches. And it's at $60,000 in cost and revenue. So let's take a look at this question. Outline 2 possible effects on FBW's break-even chart if the prices of its products are increased. And then we have another question here. Well, 2, kind of. Calculate the following values using Figure 1.1. We have break-even output and break-even revenue. Give these questions a try. Now! All right, let's talk about the answers. Let's start with 1B, that second question we looked at. The break-even output, as we already said, is 500 watches, and the break-even revenue is $60,000. We already kind of went over that. I just thought that I would include that because it's very important for the exam. There are constantly questions like this about break-even analysis. And now on to the next question here. It says, outline 2 possible effects on FBW's break-even chart if the prices of its products are increased. Points might include reduce/lower break-even output below 500 units. So if that's the case, then they would no longer be breaking even. What would happen? They would be at a loss. That's right, students. Good job. They'd be at a loss. Increase the margin of safety above 100. Increase contribution per unit when using job production. Increase revenue from sales of its watches, hopefully, if the product is inelastic. Reduce break-even revenue. You could say any of these points in order to get marks. And remember, it's 1 mark for each relevant effect and 1 mark for each relevant reference to the business. So you should mention small details about them. For example, that they make watches or that they train their employees, how many employees they have, right? Just mentioning the business in context is going to get you 2 out of your 4 points. You absolute legend. You've done it again. Good job. In the next lesson, we're going over finance, baby. See you there.